Good morning or good afternoon, everybody, and welcome to today's webinar on deferring capital gains taxes with 1031 exchanges. Now, we want this webinar to be as interactive and as engaging as possible for you guys. So as questions come up, please go ahead and use that questions tool to ask your questions, and I'll go ahead and ask the speakers on your behalf throughout the webinar. So with that, I will turn it over to today's speakers. Take it away, Tanner.
Thank you, Rose. My name is Tanner Williams. I'm an area sales manager here at Lensure and looking forward to talking to you about 1031s today.
Thank you. Bill?
Good morning or good afternoon, everybody. I hope you're going to get a lot of great information out of this. And I'm the CEO of Exeter 1031 Exchange Services and Exeter Trust Company. So happy to answer any questions you might have related to 1031 exchanges and specifically reverse 1031 exchanges.
Thank you. Matt?
Hey, good morning and good afternoon, everybody. My name is Matt Kirschenheiter, one of the area sales managers here at Lensure, based out of Orange County, California. Excited for the opportunity today to review our reverse 1031 exchange product. I think it's a great product, a very timely product in today's market, and I'm happy to answer any questions you may have.
Great.
Beautiful. So we'll go over a little agenda here. We'll talk briefly on capital gains and how that affects investment properties. We'll talk about regular 1031 exchanges and then spend the majority of our time talking about reverse 1031 exchanges, as well as our bridge loan program that we pair with that. So who are we really targeting with this call today? So, I mean, it's going to be your seasoned and savvy property investors, people that own 10, 15, 20 properties. Maybe they've even reached the cap for what Fannie Freddie will fund for them, which is 10 loans, whereas we'll go above and beyond that. But you're typically talking about your very seasoned investors who leverage financing to their own benefit, right? They don't want to own properties free and clear. They want to have loans out on those properties and have their money making money for them, right? Own 10 properties with 50 LTV loans instead of 5 properties free and clear, that type of thing, right? So they want to leverage financing, and they also want to expand and upgrade on their current investment portfolios. So, borrower owns a bunch of properties, but they're getting old, right? Roofs are going to need to be replaced, HVAC, water heaters, right? You name it. Maintenance costs are going to start to go up as properties get older. So instead of paying those costs, a lot of investors want to swap out their properties and exchange them for something newer, something in a better rental market, all that. So I venture to guess that most of you on this call are probably already familiar with the 1031 exchange. I think most investors are as well. Their CPAs at some point have had that conversation with them. Much more rare, though, is reverse 1031 exchanges, and that's why we're going to talk primarily about that. It's a lot more niche. A lot of investors and CPAs won't even talk about it, won't even bring it up. So if you are well versed in this particular arena, it's going to reflect well on you. The other thing I'll tell you about property investors is they really are not going to be amazingly point and rate conscious when it comes to 1031 specifically, because the capital gains taxes that they're avoiding paying are substantial, especially depending on state, when you have state capital gains taxes that add to federal capital gains taxes. So we'll talk a little bit about that. But overall, the investors are looking to exchange the property. They're looking to defer those capital gains, and the exact terms that comes with aren't of great concern to them, especially right now when terms aren't the best anyway. We're hoping to get people into long-term financing, here a year or two down the road as rates continue to come down.
Okay, great. And I've got a couple of questions about whether they can have a copy of the slide deck. Yes, look for an email from me about an hour after the webinar ends, and that's going to have the slide deck plus a ton of other great resources for you.
As Tanner mentioned, there's a lot of taxes that kick in with the sale of property. And so this is just focused on really the sale of any kind of investment property held for rental, investment, or business use. And it'll give you an idea of what kind of tax liability they're looking at. First rule of thumb, of course, is always have the investor talk to their CPA. Their CPA knows the total picture, and there may be other things in the tax return that would impact their decision on whether to do a 1031 exchange or not. They may have net operating loss carry forwards or suspended past activity losses that would offset the gain. and they may not need to do a full exchange or any exchange at all. So it's always important to make sure they talk to their tax advisor first. In most cases, they're going to have a significant gain with the market we have today. So this is a quick example, just to give you a quick calculation on how it would work. This assumes that an investor named James bought property in 2002 for $200,000, put $15,000 of improvements into it. Fast forward to 2023, sold it for $800,000, has a $585,000 capital gain. And then, of course, they've also depreciated the property. So there's going to be depreciation recapture issues as well. But ignoring kind of all the ancillary issues, you got a $585,000 capital gain. For most people, that's going to put them in the 20% tax bracket, which is going to be $117,000 in capital gain taxes. Then depends on your state. Nationwide, the average state tax is about 5.5%. Here in California, our top rate is 13.3%. So it depends on your state or your investor's state rate. But at California top rate, that's another $77,000. And then, of course, you've got depreciation recapture. At the federal level, that's going to be taxed at 25%. And then again, whatever the state rate is. So all of that adds up to a pretty significant number. It's going to push them way over $200,000 in taxes. All of that would be deferred if they did a 1031 exchange and reinvested in other rental, investment, or business use property. Excuse me. And kind of taking that to the next level, what is a 1031 exchange? What does it do? A lot of people call it a tax-free exchange. It's not tax-free, it's tax-deferred, although it could become tax-free. Upon death, the investor gets a step up in cost basis. Whoever they leave the property to will inherit that property with a brand new cost basis, which means all the capital gain taxes, all the depreciation recapture taxes go away. But in most cases, they're going to sell the real estate, do a 1031 exchange, and that would allow them to defer their taxes. So a lot of people call it kicking the can down the road, but it allows the investor to exchange property into other rental, investment, or business use property. And by doing that, they defer the capital gain taxes, they defer the depreciation recapture taxes, and it won't trigger any more net investment income tax or the 3.8%, which a lot of people refer to as the Obamacare tax. So it really just keeps allowing them to defer the taxes, which means all of their equity is kept in their pocket. It really gives them a chance to trade up into larger properties or multiple properties, more units or more doors, ultimately, at least hopefully, increasing their cash flow, which then increases their net worth. So it's all about, deferring their taxes, keeping the equity in their pocket, building their real estate portfolio over time, all on a tax deferred basis. So just kind of keep that in mind that anytime property is sold, they're going to talk to their tax advisor. They're probably going to have a gain, and they probably need to look at a 1031 exchange to defer that gain. And then when they do that, the sale of that property is what triggers everything. So that's going to trigger the 45 calendar days to actually identify the replacement property they want to acquire. As you know, this is a crazy market. It's a challenging market. 45 days moves very, very quickly, which is one of the reasons the reverse 1031 exchange can be such a great tool for today's market, because you can actually buy your replacement property first. Most people do the regular, or what we call forward 1031 exchange, and the risk with those is that you sell, you trigger your taxable gain, and then you have to make darn sure that you locate, identify, and actually acquire the replacement property to defer the taxes. And they have to close on the purchase of that replacement property within 180 calendar days after the close of their sale in order to defer all the taxes. If they can't locate, identify, and acquire the replacement property, it becomes a taxable transaction. So kind of walking through the process here, and this is where you can add a lot of value to your clients too, because a lot of times they don't know this. And a lot of these things are very basic. If they knew it, they would not make any mistakes. First one, most importantly, they have to have the 1031 exchange set up before closing. The reason for that is the purchase and sale agreement is assigned to the qualified intermediary. The qualified intermediary, which is our role at Exeter 1031 exchange, we step into their shoes. We become the seller. And that's what allows them to defer the taxes. If the 1031 exchange is not set up prior to closing, then at closing, the person who has the right to receive the funds is the investor, and that triggers a taxable event. So even if they tell the closing agent, go ahead and close, don't worry, but don't disperse the funds because I want to do a 1031 exchange, that still won't work, because when the closing occurs, they have the right to receive the funds. So it's important that the qualified intermediary set up the 1031 exchange and get all the documents executed before the closing occurs. Once the closing occurs, then of course the settlement agent will close the transaction. They'll list us on the settlement or HUD-1 as the seller. They'll wire transfer the funds to us. We deposit that into their 1031 exchange account, and that's what allows them to defer the taxes. And it's the closing that actually triggers all of the deadlines. So again, from the closing, you've got 45 calendar days to identify what you're going to acquire, an additional 135 days to actually complete the 1031 exchange for a total of 180 days. A lot of investors think it's 45 days plus 180, and it's not. It's a total of 180 days. When they're identifying property, there's a couple different rules they can look at. And so this gets kind of technical, but just to give you kind of an overview, most investors will sell one property, probably buy one property. So they're going to use the 3 property rule where you identify up to, but not more than 3 properties. It doesn't matter what the market value is. It doesn't matter anything else other than they cannot identify more than 3 properties. The real benefit here, or the purpose behind the 3 property rule, is they're really trying to buy one replacement property, but they're identifying 3. So they have a second and a third as backup properties. The challenge in today's market, of course, is that the second and third properties are probably long gone if they need them, but that's the purpose of the 3 property rule.
Bill, if I
Yes.
could interject for just a minute, because I do have a couple of different questions on the replacement property. Question number 1 is, can they take a single family residence and replace it with a 2 to 4 unit property? Question number 2, how does it work if a buyer is wanting to purchase 2 separate properties with the 1031 proceeds?
Good question. So for the first question, the answer is yes, they could certainly do that. A lot of people get confused on the definition of like kind. So when investors come to you, they're going to say things like, well, I'm selling a single family, I have to buy a single family. That is not true. Literally, like kind means you are selling real estate, you have to buy real estate, and that's all it means. So anything that they sell and then of course purchase through the 1031 exchange, as long as it's real estate, it's going to qualify. So they just have to make sure that it's some kind of a rental, investment, or business use. So literally they could sell a single family, they can buy a 4-plex, they can buy a larger multifamily, they can buy dirt, vacant property, commercial office, retail, industrial, etc. Sorry, what was the second question again?
It was about, and actually I just had another question about multiple properties. Can you sell one and buy a couple of different investment properties?
Perfect. So yes, there's really no limit to the number of properties you can sell and the number of properties you buy. Just keep in mind, the more properties involved, the more complicated it gets. So you have kind of 2 strategies. One is a consolidation strategy. They might sell 2 or 3 or 4 rental properties and 1031 exchange into one property that's maybe easier to manage or has no management responsibilities, things like that. The other is a diversification strategy. They may sell one larger property and then buy 2 or 3 or 4 properties to spread their risk, diversify by geographic areas or what have you. So absolutely both work. There's no limit. It just gets more complicated, but can certainly be done there.
Okay. And Joe just had a question. Joe, I think he just addressed your question about selling 3 properties and taking the equity and buying 1 property. I think you addressed that.
Yep, absolutely. And then some of your investors, which kind of goes back to the second question there, some investors will approach you and say, look, I really want to sell 1 property and I want to diversify. As an example, we had a recent client that sold a $4 million asset in Orange County, California, and wanted to buy a whole bunch of single families. So obviously he can't identify 3 single family properties. It just wouldn't work for what he was trying to do. He was actually buying in Tennessee. So in that case, he would use the 200% rule, which means he sold for $4 million, 200% would be $8 million. He could identify as many single family properties as he wants, up to $8 million in total value. So in his case, he identified a little over 50 some single family residential properties. Doesn't mean he's going to buy all those. It just means he's got the opportunity to identify a lot more. Then he can look at all of them, do his due diligence, etc. He ended up buying 26 of the single families, and as long as the 26 total purchase cost is equal to or greater than $4 million, which is what he sold, he's reinvested everything. So it kind of gives you an idea of how you can use the various identification rules to kind of work with what they're trying to do. But it does give them the ability, again, to defer all the taxes, etc. All they have to do is enter into a purchase and sale agreement on the sales side, a purchase and sale agreement on the purchase side, and then those get assigned to us, and we either step into their shoes as seller and or we step into their shoes as the buyer, and then the funds are transferred directly to us when the closing occurs, and then on the buy side, we'll transfer the funds to the closing agent once they're ready to close. So that gives you kind of a quick recap on the kind of the mechanical steps.
Yeah, I'll jump in real quick for a second too, and just say that we'll get to this as we talk more about reverse 1031s and bridge loans. But just last month, we closed a 4-pack of loans. It was 3 bridge loans on 3 investment properties into 1 purchase loan using the reverse 1031 exchange and the bridge loan program. So yeah, going from 3 to 1, going from 1 to 3 or more, you know, that is available.
Okay. Billy, were you done talking about the process?
Yes.
All right, fantastic.
All right, great. Thanks, guys. We'll talk a little bit about a 1031 exchange in action before we get into the reverse aspect and before we get into the bridge aspect where we're pulling equity from that departure property first. In this scenario, investor owns a investment property in Marietta, California, purchased 15 years ago for $188,000. Put $65,000 into the place, bringing his cost basis to $253,000. Rather than continuing to plow money into this place and potentially not receiving optimal rents for a property zone for 15 plus years that needs some serious renovations, this investor decided he'd rather purchase a new investment property. That same property now in Marietta, California is worth $600,000. Good for him, 130+% return. Message to your young investors out there, buy real estate. But he's sitting on $347,000 of cap gains, right? Then the potential tax on that with 20% federal and 7% state in California be almost $95,000, not mentioning the depreciation recapture tax that Bill mentioned, also known as accumulated depreciation, which can be taxed at ordinary income levels up to 25%, and essentially requires the investor to pay taxes on the depreciation taken during the time they own the property. Now enters the 1031 exchange process, right? With the 1031 exchange, the investor is able to transfer all the proceeds from the sale of that property towards the purchase of the new investment property, deferring any cap gains tax, kicking that can down the road.
Okay.
So let's switch now and talk about reverse 1031 exchanges. So in a reverse 1031 exchange, as we've alluded to, the investor will actually buy the replacement property first. That's what kicks off your timelines. And you're still able to take advantage of deferring the capital gains, even though you're selling the relinquished property after the fact. So the big benefit of a reverse exchange, and Bill alluded to this, is the fact the investor can shop at their own pace, right? That 45-day window in a forward exchange to identify your replacement property is very tight. The whole reason they're doing an exchange in the first place is to trade out a property they don't want for one that they do. And if you do a forward 1031, a regular 1031, you risk exiting that exchange with a property that's just as undesirable as the one you were trying to get rid of, or paying capital gains taxes, right? So a lot of risk there. And instead, doing the reverse, you're able to shop at your own pace. There's no tight window, right, to find your replacement property. As soon as you do find it, you pull the trigger on it, you go under contract, and that kicks off the timelines from that point on to sell. So 6 months to sell, a lot more forgiving than 45 days to buy, right? So this buy now, sell later, type of strategy is excellent for a market where home values are increasing, which I'd say is probably most markets right now. you're able to buy that replacement property today, when it's cheaper than it would be 3, 4, 5 months from now, and then sell your old property in that 3, 4, 5 months, for more than you could if you sold it today. So playing that swing in the market. No gap in the rental income is huge, right? When you do a regular exchange, you sell that property, and then now you have a couple months there of you're not collecting any rental income because you don't own any properties. When you do the reverse exchange, you buy the new one, and you still own the existing one. You're still collecting rents on it while you work on selling it, and can even potentially double up. And then, the thing that I'll tell you guys, which I alluded to earlier, is a lot of people don't know about the reverse 1031 exchange, and part of the reason for that is financing has been very hard to come by. A lot of people think that these have to be conducted either entirely in cash or perhaps with hard money financing. So, it just has been an option that hasn't been on the table for investors in the past. And, the introduction of us lending on reverse 1031 exchanges and even incorporating our bridge loan product, which we'll talk about, has really opened up that door.
Okay, I've got a question from Stephen. Does the new property need to be over the sales price or merely over the taxable gain amount? And he says also, how does what they owe on the current property relate to what must be reinvested, as in new loan versus old loan, etc.?
Good question. So the technical answer is you take your gross sale price on what you sold your property for. Let's just say it's $1 million to keep it even. You are allowed to subtract your routine selling expenses. So your broker's commission, title escrow, documentary transfer tax, recording fees, etc. That's going to get you a net sale price of about $950-ish on $1 million sale. And that's the magic number. That's what you have to reinvest. A lot of investors, and your question is right on point, because a lot of investors will think all you have to reinvest is your taxable gain or your cash equity, and none of those are true. It's actually the net sale price that matters. So as long as, in that example, they buy for 1 or 2 or 3 properties, and the total or aggregate purchase price is at least about $950 or greater, then they'll have reinvested all of the requirements. So it works really well there.
Regardless of if they owed anything.
Let's say you got $1 million sale price, you got $600,000 of debt, $400,000 of equity. You exchange across the board. So you buy a new property for $1 million. Typically the debt has been paid off at the sale. You've now got $400,000 of equity being held by the qualified intermediary. They're going to make a purchase of $1 million. That $4 million of equity gets moved across or reinvested in the new replacement property. And the missing gap there is a new loan for the $600,000. They can do a new loan for $600,000. They can come out with out-of-pocket cash for $600,000 and buy the property all cash, or they can do a combination of new loan and new out-of-pocket cash. But as long as they're trading equal or up about $950-ish, then they're going to satisfy that requirement. And as long as all the $400,000 in equity gets reinvested, they'll be in good shape.
Great. And I got another question from Christopher. Can the loan proceed distributions be split with a cash out?
Can the loan proceeds be split with a cash out?
Yeah.
I'm going to guess they're talking about the purchase of the replacement property and getting a higher loan with a cash out. If I'm not correct on that, just send a follow-up question. On the purchase side, you have to make sure all your equity is reinvested. You don't want to do a cash out, because what happens is the IRS will take the position that you've got equity left over that was not reinvested. Therefore, it's taxable boot. However, you can wait 2 to 3 months and then do a cash out refi, and at that point, it would not be taxable. So let me know if I was on point there or if I missed the question.
Okay.
And to kind of jump in on the mechanical steps of a reverse exchange, as Tanner said, it's a tough market, and you do a forward exchange, you sell, you can't identify or you can't close on the purchase, it becomes a failed exchange, it becomes taxable. That's very expensive. So the reverse exchange solves a lot of that issue today, because you can take all the time you want to go out and shop for the new property. There's no deadline up front. They can take all the time they want, keep looking, and when they find that right property, they can negotiate, they can go under contract, They can open escrow or start the closing process with a closing attorney or title or escrow company. And if they have to close on that purchase first, then they're doing the reverse 1031 exchange transaction. The IRS doesn't allow the investor to close on the purchase and own the new property at the same time they own the property they're trying to dispose of. The IRS has come out with what they call a parking arrangement. So the qualified intermediary, which again is us, has to set up an exchange accommodation title holder, people call them EAT. And the EAT actually is a corporation we have that then sets up a subsidiary LLC, a brand new LLC. That LLC is used only for the investor's reverse 1031 exchange transaction. The purchase and sale agreement is assigned to that LLC. That LLC becomes the buyer. The closing occurs. The LLC now has legal title to the property, and that's what they refer to as a parking arrangement. That really gives the investor now 45 days to identify what they're going to sell. Now, in most cases, they already know what they're going to sell. So it's just a formality, but they just identify what they're going to sell. They have an additional 135 days after the 45-day period to complete the sale or actually close on the sale for a total of 180 days. The difficulty there, of course, is most people don't have all cash to go out and buy the new replacement property for all cash. If it's all cash, it's complicated but very doable, but most people just don't have that kind of cash position. So we'll talk about that next in terms of the lending opportunities. But with the parking arrangement, the only thing that occurs up front is a parking arrangement. The actual 1031 exchange has not occurred. So the only thing we've done is set up an LLC, take title to the property. We now have closed, we have legal title, and you continue marketing your current property. A few months down the road, when you close on the sale of your existing property, at that point, we step into your shoes as seller, sale closes, funds are wired to us, and then we can do the wrap up of the reverse 1031 exchange. We can take those proceeds, we can pay down debt if needed, we can reimburse whoever advanced the cash to cover the purchase. So all the wrap up is done at the back end. It's really a concurrent 1031 exchange at the back end. But again, as I said, most people don't have all cash. So that's where this bridge financing comes in as a huge benefit to allow them to go out, find the property, and then buy first.
Okay.
Okay, before we touch into the bridge aspect of that, let's just look at the reverse 1031 exchange in action, where the investor has identified the replacement property first and the relinquishing property hasn't sold yet. All right. In this situation, our borrower has identified the new investment purchase in Lake Tahoe. She has a free and clear investment property in Bozeman, Montana. That property is worth $930,000. But again, she's sitting on significant cap gains on this property. She has a cost basis of $495,000. Again, property is worth $930,000. So $435,000 of cap gains, and that total tax burden, again, not mentioning the accumulated depreciation, would be almost $120,000. This borrower needs the reverse 1031 exchange to defer that tax burden and kick that can down the road. And now I'll kick it back to Tanner to introduce the bridge program and how it works in conjunction with the reverse 1031 and how we view that from a lending perspective and how we're able to pull that equity from the departure first.
Okay, I do have a couple of questions.
Yeah.
Investors are able to identify and acquire replacement properties in a state outside of their original property state, correct?
That is correct. So with it's a federal tax code, and all the states do, of course, follow that. So we're in good shape there. Let me get rid of this caller real quick. And so they are allowed to do that. All 50 states qualify. There's also some of the territories qualify. So you've got Guam, the Marianas Islands, and the U.S. Virgin Islands are also considered to be like-kind property. Interestingly, Puerto Rico is not considered like-kind property. It's a different kind of territory, so that would not qualify. That would be considered foreign property.
Okay, great. And on a reverse, does the down payment on the new property come from the borrower's private savings?
So that's what we'll talk about here on this next slide, because there are a couple options.
Okay, and can you deduct improvements from the net sales price?
Good question. and I'm going to guess most people will do improvements to get the property ready for sale. And the most common question is, can I get those back at the closing? And the answer is no. Those are not routine selling expenses. So that would either be a deduction on your tax return if they're repairs and maintenance, et cetera, or they'd be added to your cost basis in the property. With the Tax Act of 2017, there's a lot of bonus depreciation, Section 179 write-offs, et cetera. So even some of the things that were capital improvements might actually be 100% deductible. So that's one of the areas you want to talk to your tax advisor, but they can't be refunded to you through the closing. That would be considered a taxable event.
Got it. And can you change the identified property after 45 days?
Good question. No, you can't, unfortunately. During the 45 days, you can certainly change your mind, revoke your identification, identify new property. Once you pass the 45-day ID period, you're stuck with what your last identification was.
And I've got 3 or 4 different questions on can this be done with a primary residence, or is this only on investment properties?
Good question. It depends. Sorry, I'll jump in there.
You can go ahead, Bill.
With a primary residence, it falls in our different section of the tax code. So it's section 121, or what we call the 121 exclusion. So if you can say that you've lived in the primary residence for at least 2 out of the last 5 years, you'll get $250,000 tax-free per person. So a $500,000 tax-free for a married couple. I said it depends because sometimes you've got a primary residence where you also rent part of the property out. So it could be split use where most of it's a primary residence and the other part of it could be rental property. So it could be both. So it really kind of depends. Or you can convert your primary residence into investment property, rent it for a couple of years. Then when you sell, you might still qualify for the $500,000 tax-free exclusion and qualify for a 1031 exchange. So there is some planning opportunities there.
Okay, great.
Sweet. So let's talk about financing these reverse 1031 exchanges. So going back to that question just from a moment ago, you know, when a borrower is going to do this, obviously they're buying the replacement property first. And so because they're doing that, they need to come up with cash for a down payment, right? They don't have the cash from the sale of the old property because the old property hasn't sold yet. So this could come from cash on hand. You know, we do 1031 exchange lending when there's no bridge loan involved. So I'm actually doing one right now out of Colorado. So borrowers buying a $1.3 million house, putting 30% down of their own cash on hand. And that's totally fine. So as Bill alluded to earlier, when that property sells, the old one, rather, you know, the one that they're relinquishing, they can replenish that 30% down payment that they pulled from their savings account. So that's totally fine. Now, the problem is a lot of investors are not that liquid. They have their money tied up, making money for them, you know, all in real estate, whatever it may be. So that's where our bridge loan comes in to solve that problem if they don't have that cash for the down payment. So a LendSure bridge loan, you know, will come in and allow them to access and tap into the equity in the home that they are intending to sell on a short-term loan that doesn't have any penalties or drawbacks for being paid off early like normal loans would. And obviously, we've set this up in a way where it does not interfere with your ability to take advantage of the cap gains deferment that the reverse 1031 offers. So that bridge loan is a short-term loan, 6 months, no payments due on that loan, which is huge. Matt will talk a little bit later about how that can be leveraged. We will go up to 60% loan to value on that, and we do pay off any existing liens. So we are the only loan in place on that property now. And that, you know, quote unquote cash out that you're getting from that bridge loan is what goes towards the down payment on the new property that LendSure also has to be the lender on. So we do 2 loans. We do the bridge loan on the home that they're intending to sell and the purchase loan on the home that they're acquiring. The loans are basically joined at the hip. They travel through the system together as a 2-pack. So it's not like, you know, we close the bridge loan and then give you cash and then say, all right, go shopping, right? And you're on a clock and interest is accruing. It doesn't work that way. We pre-qualify you for both loans. And you go shopping with that pre-qualification in hand, and then the bridge and purchase will actually close concurrently on the same day. You know, once the purchase is under contract and we've gotten all the conditions in and everything we need. So, you know, this bridge loan is an excellent option to give borrowers the access to the equity in the home they're intending to sell without having to worry of EPO or prepayment penalties or anything like that on the property that they know they're going to be selling in very short order to meet the reverse 1031 requirements on the 6-month timeline.
Okay, Ted, I'm not sure if I understand this question, but I'm going to just read it as provided. What if your sale has enough equity to pay the bridge with no new loan?
It's a good question. Yeah. So we always have to pair the bridge loan with a purchase loan. So we can't do an all cash purchase. What we would probably do is just lower the loan to value on the bridge loan a little bit, give a little less cash out, and then take out like a small $150,000 or $175,000 loan on the purchase, even though they don't technically need it, and do it that way. And then, you know, we'll talk in a little bit here, I think in 2 slides from now, on what to do once your old property is sold. But yeah, can't do the standalone bridge, has to be paired with a purchase loan as well.
Okay. And George has a question on if you have depreciated the capital improvements already, can you still offset the gain with capital improvements? Bill, I think you're muted for some reason.
Sorry. I've been called to mute more times in the last couple of years than I've been called to mute before. So if you fully depreciated, then what you've got is just depreciation that's built up. If you're doing a full 1031 exchange where you reinvest everything, then all of that depreciation would be deferred, would not be recaptured, and you wouldn't have any tax consequences. So going back to the example I used before, if you sell for $1 million, your net sale price is $950, you reinvest a total of $950 on the buy side, then all of that depreciation would still be deferred.
Okay, great. And I'm getting some questions here with very specific scenarios about actual loans. So I'm not going to address those on this webinar because I want to make sure that we give you as complete and comprehensive an answer as possible. But I have tagged them, and I'm going to have somebody reach out to you personally to talk through your scenario and provide the most accurate information that we can.
Perfect. And adding on to Tanner's comments earlier about the new purchase loan, first and foremost, the new property needs to be equal or greater value than the departure, than the relinquishing property. So we're assuming there should be some type of loan on the new purchase. Secondarily, we're only going to do the bridge financing. We're only going to pull equity from a departure property as if we're also simultaneously underwriting the new purchase. That's how the lender protects ourselves. That's the only way we'll pull the equity from a property that hasn't sold yet, is if we're also doing the underwrite on the new purchase. And earlier, I think it was mentioned, we do these on primaries as well, not the 1031 exchange process, obviously, or the tax benefit aside, but we do these on investment primaries. So, you know, selling a current primary, upgrading to your new dream home, we'll pull the equity from a departure primary to make you a stronger non-contingent buyer on the new purchase. But back to the reverse 1031 exchange with the bridge, and back to that Bozeman and Lake Tahoe scenario. Again, this borrower had the free and clear investment property in Bozeman, Montana for $930,000. She's identified that Lake Tahoe property that she wants to be her new investment purchase. It's listed for a good price right now, and she knows it's going to move quickly. For our originators out here in Southern California, and actually throughout the country, we realize that this is a very competitive market, lack of inventory, non-contingent offers are not really, or contingent offers are not really being accepted in this market. So she's not going to really have the time to list and sell that Bozeman property and still get this Lake Tahoe property. So enter the bridge financing, pulling the equity from that home so she could bring to the down table for the down payment for the new primary, for the new investment purchase in Lake Tahoe. So with that value of $930,000 for the Bozeman home, we're going to give her up to a 60% LTV. That's the max equity we'll pull from that property, giving her a loan amount of about $558,000. Those are the proceeds that she's bringing to the table for the down payment on the new home. Less fees, less closing costs, but that's the equity that we're pulling from that property. She doesn't need to bring that all to the down payment, but everything in the non-QM world is based off of FICO and LTV. So the higher the down payment, the lower the LTV, the better the rate will be on the new home. So she's bringing $558,000 to that new purchase in Lake Tahoe, giving her a loan amount of $442,000, 44 LTV. and we'll do that new investment purchase simultaneously as we're giving her the cash out proceeds from the Bozeman home. Now she's in the Lake Tahoe property. We closed on both loans. Now she can divert her attentions to selling that Bozeman property, right? She might have some additional equity she could put into staging and get the best possible value for it. I think one of the biggest benefits of the product as well, I think Tanner mentioned earlier, is she can continue to collect rents on that Bozeman property. So she could be in the new Lake Tahoe investment property getting rents, and still, while she's selling the Bozeman property, get rents on that property as well.
Okay, Jane, I think Matt just answered your question about why somebody would need a bridge loan. If you need more clarification, please go ahead and add another question. And yes, you guys will be getting a copy of this recording. Look for an email from me, Rose Waldy. About an hour after this webinar ends, it's going to have the recording, it's going to have the slide deck, and it's going to have some great additional resources for you guys. What's the prepay on the new purchase loan?
The new purchase loan, it'll come standard with a 3-year prepay, but we can buy that down to 2 years or 1 year, or perhaps no years for certain rate hits or origination costs, and also depending on the state that you're in. But the new loan comes standard with a 3-year prepay, which can be bought down.
All right, and can she?
It's a question we'll address on the next slide as well.
Oh, okay. And can she keep some of the $558,000 in this scenario as cash?
Good question. It's going to depend on the numbers. So in the reverse exchange component, you're buying first. At that point, it doesn't really matter how much you put down or how much you reinvest. So that'll really depend on how you structure the loan. On the back end, when the sale of the relinquished property closes, then we're going to have to make sure that all the equity has been reinvested, the correct amount of debt is outstanding, and we may have to pay down some of that. So it just depends on the numbers. We have to crunch the numbers to see if that's going to trigger any taxable gain.
All right, so this question inevitably comes up. So we've talked about the bridge loan, how you can tap into some of that equity in order to provide your down payment on the purchase loan. But given that this is a reverse 1031 exchange and you're buying before you sell, the question comes up, well, once you do sell the old property, what do you do with the proceeds, right? How does that look? So first thing I'll tell you is the funds from the bridge loan that we pass through to the purchase via the down payment, they are capital gains deferred via that reverse 1031 exchange. So the equity from the original house, in this case in Bozeman, going over to the one in Lake Tahoe, via the bridge loan, that goes straight across, right? Equity to equity. But we're only doing a 60 LTV loan on that Bozeman property, right? So there's another 40 LTV there that they're going to cash in on once they sell that property. So what do we do with that? Well, there's 4 main options that the borrower is going to have. The first is to pay capital gains on that 40%, that they end up cashing out on. Probably not what they want to do, but if they have plans for that cash and they are okay paying the capital gains on it, then they certainly can do that. They can also replenish any funds they use for down payments. We talked about this earlier. The borrower is going to use the bridge loan for some of the down payment, and then provide, say, $100,000 out of pocket, to supplement that and lower the LTV on the purchase even further. Once that old property sells, they could replenish that $100,000 back into their savings account. And that would also be capital gains deferred via the reverse 1031. Third option, they can use those proceeds to pay down or pay off our purchase loan. So this ties back into the conversation regarding prepayment penalty. Obviously, capital gains tax, north of 20%, north of 30% is much higher than what the prepayment penalty would be. So it is cheaper to pay that prepayment penalty rather than paying the cap gains tax. However, if we are smart and we ask the right questions up front and structure the loan in a way that makes sense, and we know they want to pursue path 3 in this case, we would probably look at buying out the prepayment penalty, which ultimately would be cheaper for the borrower, and structuring the loan such that there isn't a prepayment penalty to be worried about just by charging points up front in the closing costs. So we always want to ask the question at the very early stages, like, hey, let's talk through this whole entire process from A to Z and what your plan is once you sell that relinquishing property. And option 4, which is the option I would suggest, and I think makes sense in a lot of cases, would be to take those proceeds and roll them into a new forward, right, regular 1031 exchange and go buy a second property or a second and a third property, right? So in this case, we can leave the prepayment penalty alone. We don't have to buy it out and increase the points on the loan. We don't have to worry about the cost of paying the prepayment penalty itself because we're actually going to leave the purchase loan alone. We aren't going to touch it, right? Once the relinquished property sells, we'll take that 40% equity that they're cashing out on, put that into a new exchange and go buy another property using that as their down payment. And we can also fund the loan on that, or it can be a cash purchase if they're, choosing a small enough purchase price. So, a couple options there. But the thing that you need to keep in mind when choosing between option 3 and 4 is that does play into the 45-day window to identify the sale property, right? You have to identify what percentage of the proceeds are going to go into the reverse exchange and what percentage of the proceeds are going to go into the new forward exchange. So that does play into that 45-day timeline. But we've done either of these. We've done all 4 of these options once the relinquished property sells, and they're all fine.
Tanner, I've got a couple of different questions about what our rates look like on the bridge. Do you want to address that?
Yeah, absolutely. So right now, rates on the bridge are 9.5% for non-owner, 9.25% for owner. The points on the bridge will be a little bit higher on non-owner as well, 2.5 versus owner at 2. LTV plays a little role in that, so there might be a little bit of difference depending on your exact scenario. But the thing about the bridge rate is it really isn't going to be a massive deal for the borrower because they're planning on selling that property 30 days, 60 days, 90 days, right? That loan is only going to be open for a short period of time and there's no payments due on it. So oftentimes people are asking about rate because they're worried about, oh, am I going to be able to balance and juggle making multiple mortgage payments? But the reality is the bridge has no payments due on a monthly basis. So it's just a deferred interest that's accruing and basically eats out of the proceeds of the sale.
Can foreign nationals hold investments in 1031 exchange?
Good question. So I'll defer to Bill on the first part of that question. I'll address the bridge loan and the financing side specifically. So right now, I actually am doing a second home to second home bridge loan for a foreign national. Per our guidelines, technically not allowed, but we've ran it past our president and it's something that we are going to do in this case. So it's on an exception basis, but we're 1 for 1 on it right now, at least, loans that I'm aware of under my umbrella. But the foreign national loans we do either are second homes or investments. So in the context of doing an investment to an investment exchange, I would think from a lending perspective we can do that, but I'll let Bill speak to whether foreign nationals can take advantage of 1031s in general.
Sure. Yeah, and as long as the foreign national is selling real estate, which would trigger a U.S. taxable gain, they can certainly take advantage of the 1031 exchange, whether it's a forward or a reverse 1031 exchange. It does get complicated in the fact that they might fall under the FIRPTA withholding requirements, and that complicates the 1031 exchange part, but it can be done. So we just have to look at the situation, find out if they fall under FIRPTA withholding, kind of go through the timeline and see exactly what that's going to do to their 1031 exchange. The short answer is yes, it can be done. We just need to look at the fact pattern.
And can you do a reverse 1031 exchange without a loan?
Yes, I mean, if you're in a position where they can do a reverse 1031 exchange, buy the new property with all cash, then it can certainly be done.
Okay, great.
All right, great. So we touched on a lot of these benefits of the reverse 1031 bridge. I think the main point is in this competitive market we're seeing today with lack of inventory, we're not seeing contingent offers being accepted. So the bridge feature removes contingencies from your offer, gives you time to sell your departure property, and gets you into the new purchase. That is the ultimate goal. They continue to collect rents on the original property while not making any loan payments. The easiest way to do these loans is with a DSCR perspective on the new purchase, right? Just looking at the subject property cash flows. But as Tanner mentioned, the bridge loan, so the cash out refi on the relinquishing property, has no payments. So if we were to do an investor income qualified loan on the new purchase, looking at borrower income rather than subject property cash flows, our loan is not factoring into the DTI payments on the new purchase, right? That property is truly unencumbered. We're paying off any existing liens. We're collecting for taxes and insurance. Nothing is factoring into the DTI calculation on the new home, which is, I think, the best feature of this loan, especially on primary residences when we're doing the bridge financing, because not a lot of borrowers can qualify with 2 mortgage payments, and the bridge loan satisfies that by removing any liens from that departure property. As Tanner mentioned, we go outside of guidelines all the time. So the tax benefit aside, or how the foreign national is claiming as U.S. taxes aside, we like to write loans for the borrowers that make sense, right? If we're slightly outside of guidelines from an LTV perspective, or from a DTI perspective, or from a credit perspective, but we have enough compensating factors in terms of income history, credit depth, we like the equity itself, we want to make loans that make sense. So we'll do these new purchase loans, like I mentioned, with DSCR. We'll do them with full doc. We'll do them with bank statements. We can even do them with asset depletion or asset qualifier, which is a great feature on the investment bridge aspect. If they're pulling a lot of equity from that departure, we could deplete some of those equity proceeds to add to their income levels. So a lot of creative ways we can get the new purchase under contract and underwritten and get you an approval there. And it is a great solution for, like I mentioned, this competitive market where we're not seeing the inventory out there and contingent offers not being accepted.
So I got a question here, but they still have to pay 6 months payments on the bridge, right?
Well, it's a 6-month term. There's no payments, right? So interest is just accruing per day from the time we fund that bridge property, the relinquishing property, until that property sells. So they're incentivized to sell it, as soon as possible, limit the interest accruals, maximize the cash out proceeds, but again, no payments on that loan.
Okay. Can an ITIN do a 1031 exchange?
Technically, again, that would be outside of guidelines. If we have enough compensating factors from an LTV and credit perspective, we would love to take a look at it. Bill could touch on the taxation side of things.
Yeah, certainly on the 1031 exchange side, an ITIN can do a 1031 exchange.
Okay, great. All right, now these, I don't know if you guys want to touch about some of the stuff that they're going to be getting in the appendix. Some requirements for the 10, more on capital gains investments. So here's some great information for you guys. You guys are going to get a follow-up email from me in an hour that has this. This is the QR code to this that has the same link. So you'll be getting this in about an hour. And this has the slide deck. It has private label resources so that you can grab some flyers and banners and stuff and start promoting these programs, this and other programs right away. There's flyers in there that you guys can download and put your logo on and put your contact information so that you can start reaching out to your investors and to your realtors. There's also a special resource from Bill's company. Bill, do you want to let them know a little bit about the resource they're going to be getting?
Sure. We get a lot of questions from investors who say things like, I talked to 3 or 4 companies, got 3 or 4 different answers. I'm completely confused as to what really matters. And it usually boils down to they're getting 3 or 4 different opinions. Not that it's right or wrong, it's just opinions. So we wrote this guidebook to really cover all of the required structures or requirements of the 1031 exchange in a way that the investor can easily understand it. And it goes through what really matters, what really qualifies, which kind of helps alleviate all the different opinions they're getting out there.
Okay, great, thank you. So please keep those questions coming. Does LendSure do the bridge for 5+ units?
No, we're doing these on 1 to 4 units. Again, I never want to say no, right? If you show me a low enough LTV and a strong enough borrower from a FICO and income perspective, I'd like to take a look, but it's a much harder product, right? There's less marketability, there's less resale in the secondary market for that, there's just less investors. So I'd say a 5 to 8 unit would be tough for a bridge, but let us know.
Yeah, I'll add on to that and say that historically our 5 to 8 units has gone to one investor in particular that does not participate with our bridge loans. As of late, 5 to 8 units have started going to the investor that does participate with bridge loans. So not in guidelines currently, but I know that since the same investor now buys 5 to 8s that buys bridge loans, it is within the realm of possibility.
Question from Paula. No age requirements on the reverse 1031 tax exchange?
No age requirements.
Okay. If the borrower paid down the new purchase with the excess proceeds after paying off the bridge, is that new purchase loan recastable?
So,
Question.
well, I'll touch on one thing, Tanner, you could add on. So they can pay down some principal, but again, we need to keep in mind the prepay on the new purchase, right? So again, come standard with a 3-year prepay, which we can buy down. You can pay down some proceeds without triggering the prepay. You know, up to 20% of the original principal balance would be free and clear without triggering the prepay. Over that would trigger the prepay penalty, which is 5% on the amount prepaid. So keep that number in mind. But Tanner, were you going to add on something?
Yeah, well, and that's a good point, Matt. I mean, let's say we're in a scenario where we bought out the prepay, right? So that's not a concern here. So the question being, can you pay down that loan and request a recast? You can request a recast. There's nothing that obligates the investor to fulfill that request, but it's always something that you can ask for. I will tell you though, again, if we know what our strategy is and what our plan is, we can structure the loan in a way where it's going to make sense. So for example, our interest-only loan does automatically change the payment based on the new principal balance. So if they were to pursue an interest-only loan and then make a large payment towards principal, that would then lower the principal balance so that the next month's calculation for the interest-only payment is now lower. And it is not technically a recast, but it certainly feels like one because your payment changed, right?
Okay.
As a interest only would be the easiest way to go about that. And I think probably should be the goal of any property investor is to maximize your cash flows. So a large majority of my DSCR loans are going interest only to increase the cash flows to get your DSCR as strong as possible. So the interest only option is a great option for that type of borrower.
Okay, and is the cost basis from it coming from an accountant, or how is it proven?
Good question. And that's really going to be a tax advisor issue. So the accountant, your CPA, your enrolled agent, what have you. So from the relinquished property side, they should be able to tell you exactly what your current adjusted cost basis is. And that'll help you make some decisions on what you want to do, you know, in terms of how much gain you've got, how much depreciation recapture you might have. And then once you complete the 1031 exchange, they would recalculate the new adjusted cost basis for the replacement property that you've acquired.
Are reverse exchanges more expensive?
Yes, definitely. Reverse exchanges have a lot more involved, a lot more documentation, a lot more consulting, and there's a lot more risk to the qualified intermediary because they're holding legal title to the property. So forward exchanges, your fees are typically somewhere in the area of $1,000 to $1,500, depending on the qualified intermediary. On the reverse exchange side, they bounce all over the place. For those who really know what they're doing, you're probably going to see fees from $7,000 to $12,000.
But you have to weigh that against obviously the risks with doing a forward exchange, right? If I do a forward exchange and I can't identify a good replacement property within 45 days, I either have to pay, you know, costs to extend and park, or I have to, you know, exit that exchange with a property I didn't really like, or I had to pay, you know, some exorbitantly high price for the property I did like because I got into a bidding war and I really didn't have a choice. I had to buy that property. I had no choice or pay capital gains tax, right? So when you talk about the cost with the QI being the difference between 1,000 or 10,000 or whatever it is, pales in comparison to what it is if you have to pay that 200 grand in capital gains tax.
Eddie wants to know, how much can a broker make on these deals?
Tanner, you want to take that?
Yeah, sure. Good question. So pretty much everything we do is borrower paid comp. So it's just going to be points up front. As a general rule of thumb, we cap it out at about 2.75 points BPC. You have to keep in mind, you know, the bridge loan is a short-term loan. It's something that the borrower technically doesn't need to do, right? They could, you know, look at a hard money option. So, you know, there is a little bit of observance we have to put into place of saying, okay, we can't shoot these points up to the moon here, because we're going to have points as a lender, right? I kind of look at it in a way, and I sell it this way, especially on primaries. I say, look, the bridge loan was going to be a contingency. There was going to be no loan, right? That you weren't going to make anything on that if it was contingency, or if they, decided to sell the house and then move into a rental for a few months, right? There was going to be no loan there. So really anything you get on the bridge is a bonus, right? It's a nice little cash in the pocket. The purchase is really what we're looking at, primarily getting paid on. So it applies whether it's owner occ or investments. I'd say for the most part, try to limit the bridge origination, to make it make sense for the borrower, and then kind of charge on the purchase, because that's really the loan that they would need, anyway, right?
Okay.
Tougher on a primary residence where your TRID rules apply, and because it's a 12-month, the primary residence is actually a 12-month term on the bridge. So on the investment property, we give them 6 months to sell the departure. On a primary, we give them 12 months to sell the departure. But because of the 12-month term, because of the lender fees, because of the closing costs, and we're collecting for taxes and insurance, there's not a lot of room for the brokers to make fee. But I say anything over a $250,000 loan amount on the bridge, the brokers are normally charging about 25 to 50 basis points, and then charging the full comp on the new purchase. And then again, hopefully down the line, you're getting another deal from this borrower when they want to refinance into more conventional rates down the line.
Okay. Can the cost of the bridge loan be added to the base on the Montana property?
Oh yeah, so we can actually finance the points into the loan amounts. All right, so we call that stacking. We could stack origination points, buy down points, BPC into the loan amount to maximize the cash out proceeds. So the cash out amount is not less those closing costs. So yes, we do give you the ability to finance the points. It's more beneficial on the purchase, right, where the borrower would be coming out of pocket at the closing table for your BPC and origination points. We could finance that into the loan amount, where they essentially finance your comp over a 30-year loan. So definitely more beneficial on purchases. But if you do need to maximize the cash out proceeds, we can finance it into the loan amount on the bridge at certain LTVs. We're not going to really go over that max 60 LTV, but if we're at a slightly lower LTV, we can finance the points in.
Okay, so how long does the borrower need to be on title? I've got a couple of different questions about this topic. Let's say he gave the property to his daughter, but she doesn't want it. So now he wants to sell, but doesn't want to pay capital gains.
That falls under my favorite answer. It depends. When they give the property to the daughter, that is probably considered a gift. If they do it properly, the father probably has to file a gift tax return, probably won't pay any gift taxes, but has to go through the process. And then the question becomes, who's the owner? That would be the daughter now. The daughter typically gets the father's cost basis in the property. So when she sells the property, she will have his capital gain tax to worry about. But if she hasn't held the property long enough, then the question would be, did she as an individual acquire the property to hold for investment purposes and then qualify for the 1031 exchange treatment? If it's a short-term hold, a couple weeks, couple months, there's a risk there. Then you want to talk to your tax advisor to see, can you undo the gift? Is that possible? That's why it depends. It just depends on the situation. There's a lot of moving parts there. So you're going to need your tax advisor for sure. You may need counsel involved to take a look at it and see what the options would be.
Okay. What happens if the original?
Sorry, it's quickly. I could simplify that from a lending perspective, is we'll need 6 months on title to do the bridge financing. Right, basically you have to treat it as a cash out refi. We'll need 6 months on title to take the proceeds from that property.
What happens if the original property doesn't sell before 6 months come due?
Good question. So then in that case, the reverse 1031 exchange would, technically fail. And we would undo the whole process by transferring the park property to the investor. So the bad news is you paid an exchange fee, went through the process, park title, all of that for nothing. The good news is you haven't sold anything, so there's no tax consequence. So they would end up owning both the relinquished and the replacement property, no tax benefit because nothing's been sold. If they continue to market the current property they were trying to get rid of, then they would have to decide if they want to continue selling it. And if they do sell it, if they want to do a regular forward 1031 exchange, or even look for another property and do another reverse.
Okay.
And building off that on the financing side, if you didn't do a bridge loan, then you're all good, right? You provided the down payment from cash on hand. But if you did do a bridge loan, then the balloon, the loan does balloon after 6 months, right? So at that point, we would need you to refinance it into, a long-term investment hold and say, hey, I didn't end up selling this. I'm going to keep it as like a DSCR and rent it. And we'd get you out of that financing with a refinance. So overall, the goal is not for us to take the property. We're not like itching to foreclose, right? We'd rather get you into a loan that makes sense for whatever you intend to do with that property.
Okay.
Yep,
And
good point.
how is the property considered identified? Do most folks bring in a purchase contract to consider it identified?
Most qualified intermediaries are going to provide an identification form in the package they give you. So it's just a matter of filling out the identification form, signing, scanning, and emailing it back to them. Each one probably has their own procedures, but that's about what you're going to expect. It's fairly easy.
Does the IRS care about what you owe on a property? Because what you owe creates more or less equity and thus proceeds.
Not really. It's going to affect the amount of equity you reinvest in the new replacement property, and then the difference would be either new debt, out-of-pocket cash, or a combination thereof. So as long as we satisfy all the reinvestment requirements, the IRS won't care.
Can you deduct your initial down payment?
Deduct. I mean, the initial down payment is going to be part of the principal or the equity put into the property. So I'm not sure what the question means by deduct. It's not tax deductible.
Got it. Okay, we're going to do a couple more questions. No funds should remain in the QI, correct? What if there's a short remainder of funds?
Correct. Any equity that's not reinvested would be considered taxable gain. So it would be taxable. It does not hurt the 1031 exchange. It just means you're going to pay tax on the difference. So let's use a forward exchange as an example. If you sell for $1 million, you reinvest at 900,000, you've traded down by 100,000. That's a partial 1031 exchange. Does not hurt the 1031 exchange. It just means you'll pay tax on that $100,000. Everything else would be tax deferred. And of course, I'm ignoring closing costs. So the closing costs would reduce that gain a little bit.
Okay. In order to avoid having to do the 1031, are there guidelines as far as if the investor maybe lived in the property for 2 years, or is that a fallacy?
Not really a fallacy. They changed the rules in 2004 and 2008. So if you have investment property and then you convert that to a primary residence, so it's investment property first, then a primary residence, and then you decide to sell, they prorate the gain between the number of years that you held the property as rental property versus the number of years you lived in it as a primary residence. So let's say that you lived in let's say you rented it out for 8 years and then you moved into it and lived there for 2 years. That's a 10-year holding period. 80% would still be taxable because you rented it for 80% of the time. 20% would fall under the 121 exclusion, would be tax-free up to the $250,000 or the $500,000 limit. So you really have to live there more than 2 years to really get the benefit.
I've got a lot of questions about what are the terms of the new purchase and pricing and all that stuff. I'm going to have an account executive reach out to you guys with this information. We have a ton of different options for the new purchase loan, so I don't want to give just some blanket answer that might not be as precise as you like. But I would also invite you to go on our website and click on the Spark pricing engine. That'll let you put in different terms, prepays, programs, occupancy, and play around to see our rates. Do you guys want to add anything to that?
There's also a bridge loan calculator on that website, on lensure.com, under broker resources, where you could plug in the departure value, payoffs, new purchase price, LTV on the new purchase, and gives you a little bridge loan calculation on how both loans would work simultaneously.
All right. Okay, and with that, I want to say thank you to all of our speakers. As a reminder, in about an hour, you're going to get an email from me, Rose Waldy, with a recording of today's session, with the slide deck, with those wonderful resources from Bill, with our marketing resources, and more. So thank you, everyone, for joining. Tanner, any parting words?
No, I just say that you know, these marketing resources that you're going to get, guys, that's the most important thing to take away from today, is actually get the word out to your agents, get the word out to your investment partners, CPAs, you know, referral partners, and say, hey, this is kind of a new world now that we're able to finance reverse 1031s. And you know, even reach out to your account executive here at Lensure and say, hey, can we do, you know, some kind of joint presentation where I get 10 agents on a Zoom call, or, you know, into a room, and you come talk to them about bridge loans and about, you know, reverse 1031s and DSCR and asset depletion and foreign national and all those different things. So we love being educators. We love partnering with you guys, right? And you know, helping get the word out about these programs, because business for you is business for us, right? So we very much want that for you.
Great. Bill, any parting words?
Good. Good comments there. You know, my thought is this is huge, because one of the things, probably the thing that qualified intermediaries face with the reverse exchange is financing, and virtually nobody does it. So this is a great product to actually get this done for you. And the reverse exchange takes so much risk out of the 1031 exchange process that it's a great deal.
Awesome. Matt?
No, I think we covered everything. It is a very unique product. There's multiple moving parts. There's 2 loans involved. Title needs to be on board with how the EAT is structured. There's non-recourse riders. So I would suggest, when you do have these scenarios, get your account executive from Lensure on the line, and let's get all the parties together. I think it's best, and the way I've seen this work the most seamlessly, is getting the borrower on the phone, getting Bill's company or another QI on the phone, getting the lender on the phone, getting all parties together, and finding the best solution. So we're here for you. In this competitive market, you need to open up the toolkit as much as possible. The low-hanging fruit in the refi agency world is gone, right? So it's a unique product that can definitely set you apart from other lenders and other originators out there.
All right. Thank you so much, everyone, for joining us today, and reach out to your Lensure account executive with any additional questions. Have a good one.
Thanks.